Today, we're digging into a question that's really exploded from the corners of the internet right into the biggest boardrooms on Wall Street. Is Bitcoin an entirely new asset class? We're going to look at the research from some major players to see how they're tackling this exact question.
You've probably heard it called a million different things, right? Digital cash, a tech stock, some people even call it a scam. But to really figure out where it fits in the financial world, we have to look at it through an investor's eyes. What is this thing really? Could it be something completely new?
And believe me, this isn't just some casual conversation anymore. Big firms are putting out statements just like this one. What you're seeing here from ARK Invest, well, it's less of a suggestion and more of a warning. They're telling the pros that looking the other way on Bitcoin could be a massive mistake. And notice how they frame it, specifically as a new asset class.
So, here's our game plan. First, we need to figure out what an asset class even means. Then, we're going to put Bitcoin to the test, a 4-part test, looking at whether it's investable, if its economic engine is unique, how it moves compared to other assets, and finally, we'll tackle that famous risk and reward profile.
Okay, first up, a new asset class? Before we can make any kind of call, we need some ground rules. What does it take to get into the club with the big players like stocks, bonds, and real estate?
So the textbook definition says an asset class is basically a group of investments that share similar traits and kind of dance to the same music in the market. Think about it, right? Stocks usually go up or down based on company earnings, while bonds are super sensitive to interest rates. They each have their own rulebook. So the million-dollar question is, does Bitcoin play by its own set of rules?
To get to the bottom of that, we're going to use a 4-part test laid out in a white paper by ARK Invest and Coinbase. They say any potential new asset has to clear these 4 hurdles. It's got to be investable, have a unique economic DNA, its price has to move independently, and it needs to offer a distinct risk-reward trade-off. So, let's run Bitcoin through the gauntlet.
All right, let's kick off with test number 1. Is Bitcoin even investable? This is the most basic, fundamental hurdle. Because if big-time investors can't actually buy or sell it at scale without causing a tidal wave, then none of the other stuff even matters. It has to be accessible.
And investability really just comes down to one word: liquidity. Is there enough daily trading action for a huge fund to build a position without sending the price to the moon? Or for you to sell without getting stuck? For a long time, the argument was that Bitcoin was just too small, a niche little pond.
But wow, the data today tells a completely different story. What's so wild about this chart is that it puts Bitcoin's daily trading volume head-to-head with some of the biggest, most traded stocks on the planet. We're talking the FANGs. And as you can see, Bitcoin's not just playing in the same league, it's right in the thick of it, often trading more than a giant like Netflix.
And to put a hard number on it, we're talking about $3 billion of Bitcoin changing hands on exchanges every single day. That's not the volume of some rare comic book, that is mega-cap stock territory. So on test number 1, investability, the data seems to shout a pretty clear yes. The market is here, and it is deep.
Okay, so it's investable. Check. But is it actually different? That brings us to our second test. Does Bitcoin have a unique politico-economic profile? In other words, what's its underlying value proposition? And who's in charge?
And this slide just lays out the difference so perfectly. On one side, you have our traditional currencies, which are run by central banks. Their supply can change on a dime based on what a small group of people decides. On the other side, you have Bitcoin. It's run by code. Its monetary policy is totally decentralized, it's predictable, and the supply is hard-capped by math at 21 million. That's it. Forever. No committee can ever vote to make more.
This quote from Bitcoin's mysterious creator, Satoshi Nakamoto, really gets to the very soul of why it was built this way. The entire point was to create a system where you don't need to trust a third party, like a bank or a government, which, as we know from history, can sometimes let you down. It's a system that runs on mathematical proof, not on human promises. And that is a fundamentally different economic engine.
So it has a unique engine. But does that engine make it drive in a totally different direction from everything else in the market? This is our third test, price independence. Does Bitcoin's price just follow the stock market? Or does it really truly move to the beat of its own drum?
And this is where the numbers get really interesting. This chart is a correlation matrix. It just shows how closely Bitcoin's price moves with other major assets. A 1 would mean they move in perfect lockstep. A 0 means they have nothing to do with each other. And just look at these numbers. Bitcoin's correlations are incredibly low. We're talking 0.06 with bonds, 0.28 with the S&P 500. Just to give you some context, lots of other assets are way more correlated with each other.
So here's the bottom line. Bitcoin's price seems to be driven by its own set of rules, things like network adoption, news about regulation, or its own internal supply schedule, not the big economic news that usually moves stocks and bonds. This low correlation is the hard evidence that it really is moving to its own beat, which is like the holy grail for an asset that's meant to diversify a portfolio.
And that brings us to the final test, and probably the one that gets talked about the most, the risk and the reward. We all know Bitcoin is volatile, but what does that actually mean when you look at the returns it's generated? Does it pay you back for taking that wild ride?
Yeah. Let's just face this one head on, because it's the #1 objection, right? The price swings can make you feel sick. For a lot of people, that volatility is an absolute deal breaker. But financial analysts have some clever tools to look past just the raw choppiness.
So on the left, you see the Sharpe ratio, which is the standard way to measure return for your risk. Bitcoin looks pretty good there. But look to the right at the Sortino ratio. This is where the story gets fascinating. The Sortino is similar, but it only penalizes an asset for the bad kind of volatility, the drops. It totally ignores the good volatility, the crazy rallies. And when you measure it that way, well, Bitcoin's performance on a risk-adjusted basis just blows these other asset classes out of the water. And this is such a crucial point to understand. What the analysis suggests is that yes, Bitcoin is volatile, but historically it has delivered massive returns for the actual downside risk you're taking. Or to put it another way, a huge chunk of its so-called volatility has actually been to the upside, which, if you're an investor, isn't a bug, it's a feature.
So looking ahead, where could the reward side of this come from? This chart from ARK gives us one model of where that future demand might be. And it's not just one thing, it's this whole mix of potential roles. It could be digital gold, a slice of big institutional portfolios, a safe haven for people in emerging markets, and a whole lot more. Every single slice you see here represents a potential market worth trillions of dollars that Bitcoin could tap into.
So, let's wrap this all up. What's the final verdict? Well, according to this institutional framework, Bitcoin seems to pass all 4 tests with flying colors. It's investable thanks to its deep and liquid market. It's unique because of its decentralized code-based DNA. It's independent with returns that don't just follow the herd. And it offers a totally distinct risk-reward profile. The case is, you have to admit, pretty strong.
Which leads us to the final and most important question. If this analysis is right, if we really are witnessing the birth of a brand new asset class, then the whole conversation has to change. It's no longer if an investor should own it, but how much. And that raises this massive question for all of us. What does the rise of a new, digital, non-government asset mean for the future of literally every single portfolio out there? Something to think about. Thanks for tuning in.